So good afternoon, everyone, and thank you for joining our session today. My name is Jim Pass, and I'm very happy to be serving as the moderator on this panel. And our focus today will be a series of various reports that the company I work for, Guggenheim Partners, recently sponsored and released in conjunction with a lot of our partners, which actually one is on our panel, Jeff Scheferman from CCR. And the topic of the various reports really is ESG and sustainability and how that will impact infrastructure development on a global basis as well as in North America. And before I begin, I think it's important to give a little background about why Guggenheim was interested in this space. And ultimately, we feel that to attract private capital, to complement the public capital that's financing infrastructure globally, but also in the United States and other parts of the Western world, we need to have ways to measure ESG as well as sustainability in addition to producing the financial returns. And so we've designed a methodology, a concept called the Sustainable Quotient, which analyzes the financial return, the return to green capital or the environmental aspect of where the project is located, whether it's a brownfield or a greenfield, as well as we analyze the impact on, from a social aspect, the human capital, what type of, concerns and considerations will an infrastructure asset do to the community. And then ultimately, the last area is really governance, and we call that transparent capital to make sure that we understand how the asset will be governed or how the capital will be contributed to an asset to make it efficient and very productive. And by addressing the standards and creating measurements of these various quadrants, we feel that the funding gap throughout the world, but also obviously in particularly in the United States, will be addressed. And so in many ways, this effort has blossomed with our reports. One report focused on the social aspect, which was done by Tufts University, and really through the Fletcher School of Diplomacy. One report focused on an aviation cargo facility that Jeff will talk about, where we use the Shore Standard, which is a standard designed by an entity based out of Switzerland called GIB. And then the last report that we did, we focused on an asset in California, Poseidon, which was a desalination plant, as well as a road project down in Latin America, where we engaged KPMG and Mott McDonald to apply various standards in addition to what we had done with the VIC project, where we used some of the protocols and frameworks, such as the Equator Principles, the SDGs from the UN, as well as Envision, which is another standard that has been really modeled after North America for North America projects. But with that background, I think it's important. I'd like to really ask the various panelists to introduce themselves and focus on how ESG and sustainability impacts their daily routine. And then once we go through that, we'll open it up for questions. And I view this really as an informal conversation because I think all five of us may have a different definition of what ESG is and sustainability, and probably in the audience. But it's an evolving field, and it's very, very important, in this age of COVID and everything else, because ultimately we have an opportunity today to build our infrastructure better, to satisfy the funding gap. And if we can do it, most importantly, we can really solve and reach the 17 sustainable goals designed by the UN. But Dan, if I could ask you to start, and the stage is yours.
Thank you very much, Jim. Thanks for the chance to be with you today. Apologies that I can't be with you visually. My webcam is failing me at a crucial moment. It's disappointing, not least because it's missed a chance to wear a sport coat, which are few and far between these days. But the subject of ESG in California, in our work with the Infrastructure Bank and the Governor's Office of Business and Economic Development, is multifaceted. California has been obviously pushing on these themes for decades now, even before the terms ESG started to take root. And in getting ready to join this conversation, I just happened to see a piece some of you may have seen in the Financial Times this week, the Independent Petroleum Association of America launching their own ESG center, which is definitely an indication of one or two, perhaps both things. One, that ESG is here to stay and is real and has reached the corners of what might be considered ESG irrelevance, or it's continuing to be part of this conversation around what is greenwashing and what is simply a market trend. And in that same article, the CEO of ConocoPhillips made a reference to the mood music having changed around ESG, and that certainly seems true. ESG is trendy, but at the same time is driving real market transactions. So is that mood music temporary or is it permanent? In California, it certainly takes on a real degree of permanence in guiding a lot of our public finance strategies. And I want to spend a minute in talking about how we are pursuing those now and hope to see the market grow. But it is worth, I think, spending some time trying to unpack what E, S, and G individually mean and the extent to which they hang together as an individual investment category from the perspective of long-term scalability of this investment opportunity. In some respects, G is the governance is the easiest to characterize. As Jim mentioned, it does go to transparency, but it also goes to representation in the governance process, which is tremendously important for the performance of companies. I think we're seeing that in this down cycle, or at least that's a core thesis of folks who have advocated for ESG, that diversity and inclusion at the governance level yields better economic outcomes. And there is good data to support that, but we need more. On the social side, in some respects, this is clearly the most fluid. It has a permanence to it. We kind of know what we mean in all cases, but it also reflects the changing dynamics of the moment. And in California, and I think as in many states and really around the world, dealing with the COVID pandemic, the durability of small business in the COVID down cycle is a social issue. So how do we construct lending? And in my shop, the infrastructure bank is also an economic development shop. So how do we support small businesses? That is the core of the social challenge in finance at the moment, and probably will be with us for quite a while. But the social embraces a range of different factors. And Jim, to your point about the importance of clarity in our standard setting, that is quite slippery. And from the standpoint of the long-term institutional investor and asset owner, I think we need to get to greater clarity about what we mean by social. The third category, where I spend the bulk of my efforts day to day on the environment, that in some respects is the easiest to characterize. It is easier to measure. It does embrace data, and it is powered by innovation, which it's a very important factor when considering capital formation and the interest of investors. It embraces innovation to solve critical environmental challenges. Obviously, those are social as well, but there is a core technology proposition that drives infrastructure investing. And if we look at where energy in particular, but climate smart investing generally is heading, it is powered by the changing nature of the technologies that are in the investor's perspective now. These are more investable and more affordable and frankly more competitive on a daily basis. We know that the sustainability transition, the climate transition, is a multi-trillion-dollar opportunity throughout the lifetimes of the folks on this call and in this conference out to 2050, which is the unit of measure for the climate challenge. But what we need, frankly, to get there, or to connect ESG as a nascent category of an investment opportunity to the core social issues of our time, climate being one, but only one, is clear and simplified standards. There are many standards, and arguably there are too many standards. We're getting closer to, I think, a unity of understanding of what we want from the standard setting world, but there are, frankly, still too many approaches in my judgment. So how do we use, and this is a point that I want to emphasize and close my initial remarks on, how do we emphasize the creation of products, not just projects, but how do we get from individual projects to investment products that embody the best of ESG standard setting, and use that to draw the continued attention of institutional investors and their advisors to what is best in class in the ESG space. In the abstract, we can speculate about what that will mean for investor interest in the long run, but how do we drive greater products into the market? And this is what the Infrastructure Bank in California is looking to do through our green bond work, our conduit bond issuances, and our loan products in infrastructure. Really clarify what the social, environmental, and governance outcomes are of the infrastructure assets that we're pushing, even as we link them to the core policy mission of the sustainability transition. This opens the door to more products and more capital market access. But the key piece in my mind at the end of the day is that this transition of investing to support social outcomes requires a long-term durable partnership between the public and the private sectors, not just in the traditional P3 sense of individual project development, but how private investors communicate with the policy community through blended finance opportunities and institutions like public-oriented infrastructure banks, so that each side knows what each other needs, and we can drive standard setting into greater product development, the alignment of public finance with the public interest, and really make this sector the future of investment and the future of sustainable capitalism, which the social moment certainly seems to be calling for.
You know, Dan, I think your comments are spot on, and you know, the one thing that it really reflects is how quickly the conversation can change from you know, having a really strong focus on climate to environment to some of the changes that we've seen in the United States and around the world with social justice and inequality and so forth. And, you know, really since, I guess, probably, you know, mid-May to early June, we've seen, you know, a lot of stage sharing, I think is the right way to phrase it, where the S and the E have really shared the spotlight. And in many ways, I think right now from, you know, an infrastructure perspective, there's a tremendous amount of effort and focus on the S aspect, making sure that projects or even, you know, products that if, you know, if you're trying to gentrify an area with a subway line or build a new prison or a wastewater facility, you know, not in my backyard really doesn't cut it anymore. And I think everybody has to understand that there's everybody who's a stakeholder has to really be part of that equation as we go forward, you know, when we, you know, move forward.
That's a great point. And I guess I would just add, and before handing over to my colleagues, a lot of what drives the environmental insult in the infrastructure space, you know, we know what the polluting sources are. Those are directly related, obviously, to social outcomes. And so when you address those environmental insults, you get social benefits as well, because the technologies are cleaner and they drive job growth in the same geographies.
Right. Well, why don't we go to Jeff to talk about, you know, your involvement with our projects and maybe give a little background how it all started, and we'll see where that takes us.
Sure, thanks, Jim. Yeah, Jeff Scheferman. I'm with CCR Airports North America. Very quickly, CCR is a Brazilian company. It's a infrastructure transportation developer and operator, equity operator. And we currently operate about 25 business units in 3 different spaces: airports, urban mobility, and toll roads. So for us, because we're a long-term balance sheet investor, we don't exit contracts. We're there for the life of the contract, and we extend it every chance we get. You know, ESG is a part of our DNA, in part because of Brazil years ago became contractual requirements. You know, if you had a concession on a road or a concession on an airport or a concession on anything related to infrastructure, there were certain contractual requirements to try to achieve what we all are trying to achieve with ESG and the SDGs. So it's part of our DNA, number one. But when we look at a project, we look at it from a very, very long-term basis. And we looked at in the aviation space here. I'm with CCR Airports. We're focused on North America. We're focused on developing opportunities on airports. About 4 years ago, we started to focus heavily on cargo because there's a great need on airports for modernized and redone cargo infrastructure. We began to develop a concept that's become more than a concept now. It's actually 3 projects that we call the VIC, the Vertically Integrated Cargo Community. Vertical because it is a vertical solution that really is helpful on land-constrained airports. Frees up the AOA, and it just solves an awful lot of operational problems on land-constrained airports. It's integrated in the sense that it's a single facility. It's a multi-user, a single operator concept, and it's a cargo community. And the community is probably what we're talking about most here, because we use that word because we've been trying to find the right standards to apply for this concept to be built at the major gateway airports here in the US. It's a community in the sense that it's not just a cargo facility. It provides a platform. It's a business platform. It provides flexibility. It provides scalability. It provides a new pricing business model for airlines to achieve much greater efficiencies. And it's more importantly, it provides a platform and opportunities beyond cargo for the community, because it will have included in the facility all kinds of amenities for workers. For example, retail, food and beverage, childcare. We're going to have medical clinics. I can go on and on and on. But all of these provide greater opportunities other than just the simple cargo operation. It provides a basis for the community to get to be able to invest and be a part of it. And so we began looking for a standard to apply. And Dan, you're absolutely correct. There's a lot of standards. And I have mixed emotions about all these different standards. I think we have a gigantic deficit to fill. It's going to be filled by large projects, smaller projects, and I think the project itself will define the kind of standard that you have to have. You have to apply to make your project really to achieve the SDGs. So I think we began as a long-term investor to work with Jim and GIB. Jim introduced us to GIB because we saw that as a new standard that took us where we needed to go as long-term investors. And so we began working on the project. These are very large projects. They're multi-billion-dollar projects. They employ a lot of people, and they have a dramatic impact on the region and the economy of the region, as well as the communities in the region. And so what we found with the SURE standard, as we began to look at it and develop it and began to incorporate it into our design and modify our designs accordingly, is that it goes way beyond the facility. This standard for us works because it's the project, and the project is more than just the construction and operation of a facility. It forced us to look at the region. It forced us to look at things we might not otherwise have looked at as long-term developers, operators of large infrastructure projects. So we really like that aspect. It took us outside the walls of the facility and into all different kinds of areas we would not have explored otherwise, to include local governance. And when I say local governance, I'm talking about government structure. Is it a home rule state? Who are the decision makers? Are they elected? Are they appointed? We looked at details that we never would have looked at before, and it forced us to look very deeply into the demographics, and it targets a standard. The standard makes us target development that really addresses the most vulnerable portion of the workforce today, and address it in a real way. And so it forced us to get way outside our technical design into the project. And I think the other issue is it goes way beyond just environmental concerns. I mean, it has all the things you would expect to see in a large infrastructure project like this in terms of protecting the environment, everything from sourcing materials to disposal of materials, et cetera. But it got us into the governance, believe it or not, really, really more deeply than we might have otherwise. And I think, what we've adopted, what the SURE standard requires, is that your governance, I should say, is number one, transparent. And it's transparent in the sense that all stakeholders are part of the governance, not just the investors, not the awarding authority, not the usual stakeholders like airlines, for example, or in our case, air cargo operators. And it requires that the reporting and the governance be objective. There has to be one set of objective KPIs, if you will, that you expect the project to perform to, and those KPIs have to be very, very inclusive, beyond the normal kind of considerations you would normally look at for a project like this. It has to be continuous. We learned too. Continuous means it's got to be across the entire life of the project. You can't just build a facility, then 6, 7, 8, 10 years later, the original investors leave, and then the government sort of looks inward and it begins to look at it simply as asset management as opposed to project management. And so it's really important that it continues through the end of the contract or the end of the project's life. And I think we had to go out and look at technologies to help us do that, believe it or not. And this is the other thing that we really are pleased with the GIB SURE standard, is that our technical design is very high tech. It's leading edge technology. It's robotic, it's mechanical, It's automated in so many ways, IT, et cetera. It's very, very advanced. But beyond that, it made us, the SURE standards made us seek technologies that would help us govern. So we're using AutoCase, which is a technology, a governance technology that helps the owners continue to be transparent, make sure the reporting is there automatically and objectively presented to all stakeholders across the life of the project. So I think that's what we've been involved with. These projects are very, very exciting. You know, we're one in LA. We developed that concept first and proposed that to LAWA, and they're in the process of looking at it, and we're biding our time. But it's again, I have mixed emotions about how many standards should you have, because the GIB SURE standard doesn't apply to every project. A smaller project that doesn't requires a long-term development, long-term opportunity to get your returns may not, GIB SURE may not apply, because you have to be able to pay for this. There's a lot of programs that cost money, and of course you need to be able to have the patient. You need to stick around long enough and be able to wait for your dividends to come and to get that IRR, you know, at the far end, as opposed to closer to the beginning of the project. And for us, you know, we had to make a decision. You know, do you pay for all this? Obviously, reduce IRR, but does that reduced IRR properly reflect reduced risk over the life of the project? Again, we're going to be there for the life of the project. And going through the GIB SURE standard exercise, it wasn't an exercise, it was a lot of work. But going through that, we decided, yes, it's worth paying for those things, because while it does in fact reduce the IRR, it does equally or more reduce the environmental, social, governance risks over the life of the project. And so we think, and we have that experience in CCR, we've learned that the hard way, that if you're going to be around for 25 or 30 or 40 or 50 years, you have to develop and design, operate, and govern these projects with these goals right at the top. And so, yeah, I think we need a lot of standards, because we have a lot of different size projects and a lot of different profiles for investors and investment opportunity profiles. But I think, you know, for the longer term projects, we could talk about this more. Perhaps you need to approach it completely different than we used to a few years ago.
Well, Jeff, thanks for those. And just to let the audience, when we talk about GIB, I probably should have mentioned this earlier. The initial stand for the Global Infrastructure Bank, or Global Infrastructure Basel, excuse me.
Basel, yeah.
And, and they're a foundation, and the SURE is a standard that they developed and they own under their governance. Before we go to Andrew, Jeff, just one thing I think it's important to acknowledge is that initially you were very resistant on doing this. You were somewhat concerned that, you know, standards could turn into another level of regulation and so forth. How do you view it now?
That's a great observation. That's the absolute truth. Well, first of all, it was going to be more costly, and I didn't know how you justified that additional cost and how you justified the reduction, the obvious reduction in IRR. I did think it would be another level of governance, if you will, or regulatory regime that we have to go through. But at the end of the day, I've completely reversed that. I'm totally sold, because at the end of the day, we took the LA project and we applied it to the GIB SURE standard. And the results of well, you saw the report, and this simply says that were we to build that today, we would have this gold standard. But as I went through the governance requirements, as we looked at the environmental requirements and the social requirements, the inclusivity requirements, et cetera, the things it forced us to think about and achieve a solution for, change. You're no longer looking for a way around an environmental impact report, for example, by breaking it up. The typical practices that developers do. You find a solution where you want that environmental impact report. You want it to be right. You want it to be robust. And the project, the technology, the design, the concepts, the business model allow that to happen. So the standard itself, Jim, the process of achieving that standard allowed me to overcome my question marks, because it forces you to design the project to accommodate that. It's kind of hard to explain, but once you get it there and you see what the project looks like at the end of applying the standard, those typical kind of fears that all of us would look at as we look at any kind of standard being applied to a building go away. We were going to build to a LEEDs silver, and this is far beyond LEED silver or gold or any other standard for that, because it goes way beyond just a facility.
Well, I think your story is actually a great lead into Andrew. As a fund manager and looking to raise capital and looking at projects, are some of Jeff's observations through his experience. I guess, kind of you're getting those questions when you're out there trying to fundraise in this virtual age.
Yeah, definitely. I mean, I think the investor, the LP market, the sort of pension fund investor market, has always taken social responsibility seriously, but I think the sort of focus on resilient, sustainability, responsible investments has become far more acute in the last 12, 24 months. The sort of story for me with ESG comes in almost two halves. One is a lot of what we talked about here, which is almost the sort of challenge of it, almost a sort of slightly negative sort of point about challenge. And one of those negatives we haven't really talked about, I think Dan mentioned it, was this whole issue of greenwashing. I mean, I think that a lot of fund managers are, ESG is important. We're gonna put a picture of a wind turbine on the front of our brochure, and we're going to claim that we're environmentally sensitive. Well, for a start, ESG is not just environmental.
Right.
And interestingly, actually, I think that socially, when investors think of ESG, generally speaking, gross generalization, but generally speaking, European investors are well advanced on the understanding of the environmental. US investors have been heavily focused on governance for a long time. And the bit that we think is often missing is the social. And I'm glad to hear a lot of the conversation today is about the social. So yeah, I mean, there's a huge amount more interest. There's a huge amount more focus. I mean, I think to reinforce some of the points that have been made today, sorry, I probably ought to do a quick introduction. I mean, I've been doing infrastructure investments now for 25-ish years. The team has led over $60 billion worth of infrastructure mandates, and we've developed 9 infrastructure funds and platforms previously. We are currently raising as a team for our 10th. We are heavily focused on ESG, but before ESG even became ESG, if you go back to CSR, corporate social responsibility, responsible investment, responsible corporate responsibility early on. And in fact, the fund's name is Tri-Pillar, and Tri-Pillar, for the name of the fund, is based on the 3 pillars that have founded the team, and it's the expertise, integrity, which is how we partner with people and take the sort of long-term approach on this, and then alignment, which captures that sort of governance, good governance, and long-term incentives. And just to put it all into context, one of the advantages I suppose I have over Jeff is that we are very much focused on lower mid-market. So these are small, highly impactful social projects in communities, and that's really where the team comes from. And a really interesting exercise that we've done recently is to go back through the team's track record and look at all of the projects that we've developed and pick up where those projects have met, the either acceptable standard or best practice at the time that they were developed. But then actually, more importantly, where have they gone beyond that best practice? Where have they gone beyond the sort of minimum requirements? And the phrase that we've actually picked up on for our team is that we tend to think in a term of progressive ESG. the negative part of this, yes, there are over 20 in standards, and they all have slightly different variances. And I think you guys worked on a report that picked up all of the differences between all of those systems, which was very helpful as well. But all of those are also only a point in time. Mm-hmm. So they say this is what the reporting requirements and standards are required as of now. What they don't do adequately, we think, is say, well, actually, if you have a long-term commitment to ESG at the core of your business, then actually it's not just about meeting the sustainable standards now, the responsible or governance standards now. It's about creating something which is built for the long term. And this comes back to that sort of responsible investing. So what we look to do is to create progressive ESG. So by putting this absolutely at the core of what we're doing, it puts it into not only the project evaluation, but the long-term operation, and also into all the stakeholders. Now, the great news about this, yes, there's confusion, there's 20 systems, each of those have different measuring. There's a difference of interpretation across the different social societies and geographies. The great thing about this is that actually, and this has been picked up by both Dan and by Jeff, responsible investing, putting ESG at the heart of what you do, is good business sense. That's the great thing about this. That's, forget all of the complexities, forget the fact that you've got 20 different systems, more than 20 different systems. Forget the fact that it's only a point in time, and actually we would like it to go beyond that. The key thing here is that actually doing it, bringing responsible investing, ESG investing into the core of what you do, actually adds to the bottom line. And this isn't just about, again, the other phraseology, triple bottom line. It's not about that. It's about actually making the returns work. So, as I say, we've just done an exercise where we look back over 177 projects that our team have delivered over the last 25, 30 years. And if you plot those against best practice, 99% of those projects that our team have delivered have met best practice. Now, we're quite proud of that. What we're even more proud of is that 64% of those 177 projects have gone beyond best practice in either E or S or G, and gone beyond the sort of standard requirements, either at the time they were being developed or actually have continued to improve. So, I'll give a couple of quick examples. I mean, street lighting projects that we've worked on, at a point in time when they were developed in 2006, 2007, the technology was there for lower powered lights. Yes, they were all replaced with lower powered lights, but then you bring in 2012 to 2014, the computerized management control systems where you could dim and increase. So actually we engage with clients to replace those and to bring that in. Then you come into the LED technology in the last sort of 5, 6, 7 years. And again, huge impact in terms of replacement of those bulbs. Now, from an asset owner's point of view, there's no particular commercial drive to do that, because ultimately the client is the one who pays the energy bill. But I tell you what, from an ESG, from a social point of view, absolutely core to what we do. So again, by doing these things, by engaging as a custodian of infrastructure and putting ESG at the core of what you do, and we have over 250 sort of risk and ESG evaluations that we build in right at the front end of evaluating projects. By doing that, you're creating a sustainable project, one that actually your users, your clients, the investors, the contractors, the operators, all actually believe in as a long-term sustainable solution. And if you're doing that, guess what? Then the returns are come up with it. And it's fine for me to say it. I won't go into give you another example of a hospital in Canada. It's a great example where actually we gave up some retail income in order to finance a breast cancer clinic, and that ultimately reduced time for patients coming into the hospital from initial prognosis or initial reference through to prognosis by about 4 weeks. Now, we can't quantify the value of that. You cannot quantify the value of that. But what we can quantify is the value of the relationship that it added to with the health authority that we're working with. And therefore, when one of these projects has a problem, guess what? You've got a client that really believes you're there and working with them for the long-term responsible operation of the project from their user's point of view. And actually that solves problems and therefore protects the value of the investments you made. So as I say, we could talk for hours about all of the complexities, all of the differences, this progressive versus static ESG. But to me, the best piece of this is it makes sense.
We don't have hours and we're going to run out of time. It's fascinating. But before we go to Manuel, the one thing I want to say real quickly is that one of our things that we've observed at Guggenheim with all our papers is that more people get involved in the planning, and you almost do like strategic, value engineering up front. The return figures, the estimates will be better because we're not going to get diluted when we have more and more capital requirements, whether it's on a loan side with greenwashing or on the equity. But Manuel, why don't you kind of highlight your thoughts, and we may not have a lot of time for questions, but use as much time as I promised you.
Basically come out of the real estate development business. So at this point, we've developed a lot of land for builders, done commercial, multifamily and townhomes. And we're starting to look at ESG a little bit more seriously because one, the investment community is demanding it. And second of all, for some of the reasons that you all described, it has beneficial results. But in my own mind, I find that, and we're thinking going further afield than real estate. Some of the things you discussed, I'm having a hard time figuring out in my mind how you monetize that. And I'm especially concerned in an environment of compressed returns. And also there's a time element involved. I mean, there's a lot of money that can't find its way into the sector for a variety of reasons. And we've also thinking in terms of a model where, like multifamily, it's a proven model. You don't have to convince people that it's going to work. There's decades of experience with that kind of stuff. And so adding to the ESG, we think will enhance it. And we're looking at, and you don't have to prove sustainable returns. It's been proved. So that's one of the reasons we're maybe a little more primitive in our approach to this entire thing. But basically, I'd like to reserve my time for any questions. I have a couple of questions for Jim. That's what I'd like to reserve my time for.
Well, why don't we maybe fire away, and then we've got about 5 minutes left, and then we can ask around, and then we'll go to the next session.
And the question I have is for, when you do, I read your presentation, very elaborate, and I wanted to ask you how you settle on a certain, for want of a better word, a certification model among the numerous ones that are out there. And what specific advantages does that particular model afford the investor group with which you're dealing?
Well, it's a great question, and I would tell you when, like for example, with the CCR story at LAX, GIB was one of our strategic partners at Guggenheim, and we really chose them to bring them to North America. Most of their exposure is in Europe as well as Asia, and we wanted to see what their SURE standard would illustrate to a concept. And that's really what the VIC is at the moment. It's not in construction, and it was very early on in the planning stages. And we're not endorsing SURE, we're not endorsing the VIC. We're just trying to really educate and lay the groundwork, we believe. And Dan, this may go back to really what California is trying to do as well, is to design a sustainable infrastructure asset class as a model, so sustainable investing can really be used in all different sectors. And ultimately, when our initial study was done a couple years ago with Stanford, there's roughly about a dozen or so standards out there. And rather than converging, they're diverging. And so everyone wants to have their own standard. They want to analyze a project, whether it's ESG and different questions, but ultimately it's going to take, a governmental body or, really the private sector to accept the standards and really highlight which ones are important. Because ultimately, when you're investing, let's just say in a green bond, the rating agencies have already taken the lead. They have established criteria, and they can downgrade or upgrade based upon that green classification. But from an equity investor, it's a challenge because ultimately, there's no, my return of capital would be penalized if I don't maintain a sustainability score, but that score has got to be acceptable to all investors, and the data has to be efficient, has to be accessible. And ultimately, I think that's our biggest challenge, is that an airport developer or cargo developer, like Jeff, may have a different view of his standard, while if there's a project in Asia or Europe, may use a different standard. And so we're really comparing apples to oranges. And one thing that's a story I learned during our papers is that when the EU was formed, or prior to that, every country had their own accounting standards. And it finally took the EU to form to have a common standard for accounting principles. And that really attracted tremendous amount of capital, both on the debt side, on the equity side. Not saying that's going to happen with ESG and sustainable investing, but there does have to be some type of acknowledgement that everybody's going to have to come to some form of agreement, because realistically, everybody has their own definition, and there's not a right or wrong definition. But if we could really focus it on, quantitative data, I think it'll be very, very helpful. And I think that truly, Dan, when you're looking at projects in California, everybody wants to be certified as green, but who does the certification? What's their training? How do we remove their own bias and make sure that they're following the data? And I think we're, the next 10 years will be a challenge for all of us with everything that happens in the world today, and it'll be very, very fluid. But it's an area that we think there's a tremendous amount of growth. But if we had this session a year from now, we hopefully would have a maybe a more precise answer for you. But it's going to take some time.
Okay, thank you.
Dan, any final words? Unfortunately, we only have a couple minutes left.
Well, I'll just be really brief and say that you highlighted the transition from like a civil society driven definition in the green space to when Moody's, Fitch, S&P took over green bonds. That's the sort of transition that we need to see across the board for ESG. And it gets to a place where you say, this is enough. This is fit for purpose. We want to be able to add other social outcomes to the metric, but we have to drive transactions. And it's too easy to get wrapped around the axle if we're going down to every 10th decimal place definition. We need to move capital in the areas that we know we need it.
Correct. Andrew?
No, not much to add. I mean, I'm an optimist rather than a pessimist in all of this, and I think the fantastic thing about certainly the infrastructure that we're involved in, infrastructure itself has a big potential to be damaging. Concrete, steel,
Yep.
Massive latent energy requirements. But actually taking that into account and assuming that society requires infrastructure to operate, you turn your tap and the water comes out. Actually, how you deliver that and how you deliver responsible and sustainable long-term investments to us is absolutely key. And it's additive, not subtractive to us.
I would agree. And Jeff, our final words? We got about a minute left.
Yeah, I would say that, we do need a standard. Like any standard, it has to achieve what you're trying to achieve. And under that, it has the three pillars to any standard: reasonableness, fairness, and consistency. If they're not in all three of those, then the standard isn't a standard at all. If it's not reasonable, it's not fair. If it's not fair, it's not consistent, on and on and on. So I think that's what we should be. I think the focus as we develop the standard should be on governance, because it provides many of the things we're talking about today, that objectivity, that inclusivity, that long-term view of the project, and get you outside the facility. So I think, yeah, it depends on the project. We all have to look at it as business people and figure out what the return is going to be. But like Andrew said, if ESG is the core of what you do, then it's good business.
Well, I'd like to thank everybody for participating today. Andrew, thank you for staying up a little late in London, if that's where you are. And thank the audience for participating and listening, and have a great rest of the day.